Let's start right here on the Nifty daily chart. You can clearly see that opening gap down this morning. We opened around 22,050, and from there it was pretty much one directional. There was a brief attempt to recover around the 10:30 a.m. mark, but sellers stepped in hard. By afternoon, we had sliced through the 21,900 support level, and the index just bled out into the close, finishing near the day's low at approximately 21,964. That is a textbook distribution candle. Long body, close, near the low, higher than average volume. Observers would note this kind of candle typically signals strong selling pressure. Now zoom out just a bit. Look at where we are on the weekly chart. We have now closed below the 22,000 psychological level for the second time in the last 3 weeks. That is something the market structure folks will be watching carefully. Whether that holds or breaks further, that is what the next few sessions will tell us. Screen share, Sensex, intraday chart. Jumping over to Sensex, same story here. The index was down over 1,200 points on an intraday basis, closing somewhere around 72,600. Look at this intraday chart. There was a sharp fall in the first hour, a mild bounce between 11 a.m. and 1 p.m. where it looked like buyers were trying to stabilize things, and then a second leg of selling into the close. That two-leg structure intraday is worth noting. It suggests the selling was not just panic at open. There was deliberate, sustained selling pressure throughout the session. So why did this happen? Let's talk about the elephant in the room. Transition, news map visual of Middle East. Tensions between Iran and Israel escalated significantly over the weekend. There were reports of missile exchanges near the Strait of Hormuz, and that immediately spooked global energy markets. Now, this channel does not make geopolitical predictions, but what we can observe is how markets historically react to Middle East tensions. And crude oil is always the first domino to fall. Screen share, crude oil chart, Brent. Pull up the Brent crude chart. Look at this move. Brent crude jumped approximately 3.8% overnight to trade above $88 per barrel. WTI also moved higher, crossing $84. Now, India imports over 80% of its crude oil needs. When crude spikes like this, the market immediately starts pricing in two things. First, higher input costs across sectors like paint, chemicals, aviation, and FMCG. Second, potential widening of the current account deficit, which puts pressure on the Indian rupee. And sure enough, the rupee weakened. USD INR was seen testing the 87.20 level intraday, which also contributed to FII selling pressure. Foreign institutional investors tend to pull back from emerging markets when the rupee weakens rapidly because their returns in dollar terms get eroded. Screen share, sectoral heat map. Now let's look at the sector-wise damage on the NSE heat map. This is telling. The hardest hit sectors today were oil and gas, which might seem counterintuitive since crude rising should benefit upstream companies, but actually the refining and marketing companies like HPCL and BPCL face margin compression when crude rises fast because their retail selling prices are regulated. HPCL was down over 4%. BPCL fell around 3.5%. Aviation was another major casualty. Indigo, which is Interglobe Aviation on the NSE, fell roughly 5% intraday. Aviation fuel accounts for a massive chunk of airline operating costs, so a sudden crude spike directly hits their profitability projections. Paint companies, Asian Paints, Berger, both fell between 2 and 3%. Crude derivatives are a significant raw material for the paints industry. Chemicals and specialty chemicals were also under pressure. Look at PI Industries, SRF, Atoll, all red. Metals had a mixed session, but the broader selling mood dragged most of them lower as well. Screen share, Nifty top losers table. Here are the top Nifty 50 losers for the session. Tata Motors was among the biggest drags on the index. Ultratech Cement saw selling. Infosys and Wipro fell slightly, but IT, as a sector, actually held up relatively better than the rest, largely because a weaker rupee is actually beneficial for IT exporters. That's an interesting observation. While most of the market bled, IT was somewhat of a cushion. HDFC Bank and ICICI. Banks saw moderate declines. Financials generally fell about 1 to 1.5%, which is less severe than sectors directly tied to crude. Return to Nifty chart. Now, from a purely observational standpoint on the chart, where does Nifty stand structurally? The 21,800 level has been cited by multiple technical commentators as a key support zone. Below that, 21 hours 500 is the next significant area. On the upside, 22,200 is now acting as resistance. That's where the index failed during today's attempted recovery. The India VIX, India's fear gauge, jumped to around 15.4 today. It had been hovering in the 13 to 14 range last week. A rising VIX typically corresponds with increased market uncertainty and faster price swings in both directions. Again, this is purely observational. Final segment, macro context. Let me put this in broader context. Globally, U.S. markets have also been jittery. The Dow Jones was down over 400 points on Friday, and Gift Nifty futures had already signaled a weak opening for Indian markets this morning. Europe opened lower too, with the DAX and FTSE both under pressure. The combination of geopolitical risk from the Iran-Israel situation, a crude oil spike, a weaker Rupee, and already fragile global sentiment, all of that hit at the same time today, and the result was a sharp single-session decline. What happens next depends heavily on whether crude stabilizes, whether there's any de-escalation in the Middle East, and how FIIs behave over the next few sessions. Those are the three things worth monitoring closely if you are trying to understand market direction from here. That is today's crash breakdown, guys. All data referenced here is purely for educational and observational purposes. If you found this useful, drop a like, share it with someone who was confused about today's market, and subscribe if you are new here. I will see you in the next one.